Why is inflation scarier than a market crash? So, inflation is now the number one fear, with 6 in 10 Canadians concerned they might not have enough money to feed their family, according to an Ipsos Reid poll. Most Canadians have never experienced high inflation. It's been flat at 2% for 3 decades, but jumped to 8% in 2022 and is now down to 5% in 2023. So, inflation has a major effect on your life and your finances. Many people are asking me, what's going on? Can I give them some context? So, looking at inflation in the past is very helpful to understand what's happening today. So, what we're going to learn in this video and podcast is, why is inflation scarier than a market crash? How do inflation and market crashes affect your retirement plan? Why are our expectations for inflation so critical? Should we be worried? How long will it last? What's happening with each of the causes of inflation? How does today's inflation compare with past periods of high inflation? And how can we fix inflation? So that's what we're going to talk about today. So, first, why is inflation scarier than a market crash? This is a really important concept to understand because it has a major effect on your life and your finances. Market crashes are temporary, but inflation is a permanent increase in our cost of living. So, the stock markets have recovered from 100% of declines, but inflation compounds on our cost of living. The 8% inflation in 2022 is added to the 5% inflation today to mean 13% higher cost of living for you. We do not expect negative inflation, deflation. So that 13% is there for the rest of our lives and is added to inflation of every future year. Over decades, this is huge, and that's why it's such a big problem. So let's compare bear markets and inflation. There have been 26 bear markets, so that's a decline of 20% or more in the stock market. Since 1900, the market has recovered 100% of the time. 88% of the recoveries were in 1 to 2 years or less. The risk of a market crash is just you if you panic and sell after the decline. If you stay with it and it recovers, then you're fine. We were officially in a bear market in 2022 since markets were down more than 20%. They appear to have bottomed October 2022 and have bounced back partly now. They may or may not fall further, but if they do, they'll recover all of it. There's a good chance we will have a recession, but stocks usually rise during a recession. They're always anticipating, so they usually fall before a recession and then rise during a recession, anticipating the economy is recovering. So for long-term investors, your main fear related to market declines should be missing the inevitable recovery. Major stock markets have recovered from 100% of declines. So today is clearly a buying opportunity for investments. Our growth manager considers this the best buying opportunity the last 30 years for his growth stocks. Stocks are on sale and the sale is temporary. So when the market crashes, but you stay invested and it recovers, you've not lost anything. This does not happen with inflation. So let's compare inflation. Inflation is a permanent increase in our cost of living. It piles on top of all past years. A year of high inflation is not followed by a year of negative inflation, which is called deflation, to offset it. 1 or 2 years of inflation is not a major problem, but if it lasts for quite a few years, it's a huge problem, and it's your number one problem. Your cost of living takes a big jump every year, and they pile on top of each other. So a long period of high inflation is what I worry about most for our clients. I've studied the effect and experiences. The 1970s and 1980s were 2 decades of high inflation, which were really the worst time for investors of the last 150 years. Worse than the Great Depression, believe it or not. And I'm going to show you why, because the Great Depression is just a market decline. Inflation is worse. So I learned this by looking at the reasons that the 4% rule failed. So I tested this general rule of thumb that says you can retire and withdraw 4% of your investments each year, increase it by inflation, and it should last for a 30-year retirement. So with a portfolio of 100% stocks, the 4% rule succeeded 97% in the past 150 years without any extra management. It failed only 5 times, but once because of a market crash, retiring right in 1929, just before the market crash, but 4 times because of inflation, retiring in the late 60s, just before 2 decades of high inflation. In this chart, you can see every line is a 30-year retirement for someone doing the 4% rule. Notice the times the portfolio fell below zero. So, in short, high inflation for 2 decades is almost the only reason the 4% rule has ever failed in history. This is why high inflation that lasts could be the single biggest risk to your long term finances, even worse than a Great Depression size of market crash. Now, inflation expectations, specifically the expectations, are the big fear. So, all right, because then it's hard to get rid of. My first jobs in the 1980s, inflation was 10%. So we all expected a 10% cost of living raise. COLA, everybody talked about COLA, cost of living. A buddy of mine quit a job after an 8% raise. He considered it a pay cut. It was insulting to get a raise lower than inflation. Inflation had been high for a while and was the expectation. It was ingrained. We all assumed everything at the store would go up 10% every year and our incomes would go up by 10%. If inflation lasts long enough that the public expects it, then it's really hard to bring it back down. Then, because they're always expecting it, and wages and salaries are going up by that much every year, too. It took interest rates at 20% and two recessions to bring inflation under control. This was a valuable lesson we all learned. I worked for a savings and mortgage company in 1982 at the peak of interest rates. We offered GICs at 19.9% and a 5-year fixed mortgages at 22.75% per year. The 1-year mortgage was only about 15, but people were taking the 5-year fixed because rates were shooting up. They expected interest rates to go up to 30 or 40%. Many people lost their homes when their mortgage came due and their payment doubled. These unaffordable interest rates were the only way to stop inflation once it became an expectation. It caused recessions in 1982 and 1992, which finally brought inflation down to the 2% low inflation we enjoyed for the last 3 decades. So here's our inflation history. Note how it stayed high for 20 years through the 70s and 80s, and what a great period of low inflation we've had for the last 30 years. Now, let's look at similarities between now and the 70s to 80s. So, we're at a risk of a long period of high inflation, or are we at risk of a long period of high inflation, like those 2 decades with high inflation? Will inflation become an expectation? Most of the causes of inflation are similar today, but not all of them. So, interestingly, the causes of inflation include some eerie similarities. So, the first one is an oil shock. So, inflation took off with the Arab oil embargo in 1973. The cost of gas leaped, and with it, the cost of gasoline and everything that's shipped. Today, we have an oil supply disruption from the Ukraine war and a supply shortage from the restart of demand after the COVID shutdowns. Another parallel is high government deficits. Governments printing money is a major cause of inflation. Too many dollars chasing too few products and services. Almost all of our government debt in Canada was accumulated in the 1970s and 80s. We had a Trudeau government with Pierre Trudeau in power from 1968 to 84. Now we have a Trudeau government since 2015, and the government debt has almost doubled, mostly from COVID spending. Now, we learned our lesson after 2 decades of high inflation. Governments balanced their budgets and debt did not rise from 1996 to 2015, other than a few years right after the 2008 Great Depression. Here are the last 60 years of federal government deficits. So that's current year overspending. Note that the large deficits in the 1970s and 80s, I noticed one's below zero, and the surpluses since 1996. So we had the surpluses basically from 96 up to 2008, just before the crisis, and then the 2008 crisis. Anyway, we had a temporary deficits, but they recovered in just a few years, and the intention at that point was still to get them to surplus. So we had 20 bad years and then 20 good years. Okay, note how little we owed before. So now let's look at the last 60 years of debt, federal government debt. That's the total we owe. Note how little we owed before 1970. It shot up during 2 decades of high inflation, slowly came down after 1996, jumped up during the 2008 financial crisis, stayed high for a few years, and then has been rising since 2015. So that's kind of the story. So again, government debt, 20 bad years in the 70s and 80s, and then 20 good years from the mid 90s to up till 2015. Now, is inflation temporary? If I have scared you up till now, don't worry, probably temporary. It's important to understand why inflation can be a big fear, However, I believe it will not last long and should not really be a major problem for us. The general expectation of economists and my personal expectation is that inflation is temporary, quote unquote. It should be back to the 2 to 3% range in a year or two, we think. This is the most likely scenario, which is why I'm not really concerned today. However, this is far from definite. Economists are often wrong. It was only a few months ago that they were considering inflation, transitory, meaning it should only last a few months. But that was clearly wrong. The current expectation of a year or two is likely right, though. To understand why, let's look at each of the major causes of inflation to see whether or not they will continue. So, first, let's look at gas prices. So, gasoline prices at the pumps have been painful. They jumped about 50% from February to June 2022, and they almost doubled from before COVID, but have come down to the early 2022 levels now. This affects the cost of everything. Many experts think gas prices have stopped rising. Inflation is a 1 year comparison. So June 2023 will show gas prices lower than the peak of June 2022. Now, so why is this an issue? So supplies are catching up after the global supply shock from the Ukrainian war and the end of COVID. The gear up of supply, especially at oil refineries, was slower than the gear up in demand. We're getting back to normal now. The Ukraine war only affected oil price briefly. Importing countries changed sources, but the total supply is not really affected. So remember, inflation is the rate of price increases. So if gasoline stays at this level and stops rising, then it's not causing inflation. Oil prices are political all over the world. It's not just a local supply demand issue. So they are hard to predict. It's most likely, though, that gasoline does not rise a lot from here. However, big jumps in the carbon tax, like the one today, will likely mean somewhat higher prices. So food, let's just talk about food. So sharply rising food prices at the grocery store affect us all directly. Food is one of the highest areas of inflation, and it has stayed high. Prices are still rising a lot even now. So now it's not price gouging. Loblaw is kicking all Frito-Lay products out of their stores for 2 to 3 months last year, showed the battle to keep prices low. They should stop rising food prices and even come down as supply chain bottlenecks ease. This may take a year or two. Whatever happens with the price of oil has a major effect here, though. Oil is the main cost of both transportation and fertilizer, so it's a major cost of all food. So housing, another big piece. A major part of inflation is the cost of housing, both real estate prices and mortgage payments. So real estate prices are pulling back as the froth and overbidding's gone. Super low interest rates fueled real estate prices, but are probably gone for years. However, prices are not likely to fall much because we have a systematic housing shortage. We have what I call the battle of two governments. So going on between the federal government and the municipalities, and that's likely to keep real estate prices rising over time. The federal government wants increasing immigration, which helps grow our economy. A larger population means a larger economy. However, immigrants are also, on average, more highly educated and more entrepreneurial than people born here. So that's a plus for us. But we don't build enough houses for them, enough homes. So municipalities want to keep their character and limit growth. Toronto's had a history of keeping multi-unit homes out of many neighborhoods. The 1912 bylaw number 6061 banned apartments in much of the city. This NIMBY culture, not in my backyard, is still strong. And Vancouver has a different problem. They have limited space inside the bridges that surround most of the city. So the housing supply shortage is likely to continue. Immigration is still a lot higher than the new home construction. However, the rate of increase in prices should go back to pre-COVID levels. Now, there's a risk at some point they could drop. Canada did not have real estate price decline after 2008 that the US had, so we are long overdue for a price fall. So there is some risk there. Mortgage payments have jumped with interest rates finally coming off their near zero rates. Mortgage rates have essentially quadrupled from about 1.5% to almost 6% now. Interest rates have probably peaked. As long as inflation gets under control, this means mortgage payments have jumped a lot. After this year or two, assuming inflation comes under control, interest rates may come down a bit and should go back to normal pre-COVID level. So this rise in interest rates is just going back to normal. We should expect interest rates to stay in the 3 to 5% range. So they're not going back to the 1 to 2% range we had a year ago. They're not going back to that. They're going probably to the 3 to 5% range is what we think. Still, that's a bigger cost. The mortgage is bigger cost for our mortgage payments, and also, indirectly for rent. All right, now another big area is worker shortage. We have a worker shortage. Unemployment is at 4.9 right now in 2023. This is the lowest since the 1970s. Many businesses are still complaining they can't find enough workers. We see it mostly with restaurants, nurses, construction, and manufacturing. Most industries have a worker shortage today. This started with the reopening after COVID, with people not wanting to go back to work until their CERB and EI benefits stopped. And because of COVID hesitancy, the initial shock from COVID-related issues should work itself out and normalize. So it basically has. So, however, we also have structural labor shortage that's going to get worse over time. My view is that low unemployment is not from a strong economy, since our economic growth is really anemic now. So low unemployment is mainly from people dropping out of the workforce, and two main causes. So many people enjoyed working from home, WFH, during the COVID, and now want to continue to work at least part-time from home. We see lots of self-employed that have started new online business, side hustle, working from home. Many people used to have more than one job, but now have a part-time job and a side hustle from home. They used to be considered unemployed, but not anymore, even though they don't have a conventional job. Now, the other factor is that the baby boomers are our largest generation. About 20% of our workforce are baby boomers, born from 1947 to 1964, according to Stats Canada. The peak was 1961. With more Canadians born in 1961 than any other year. Now, the peak age that Canadians retire is at age 62. So the baby boomer peak is people age 62 today, this year in 2023. So 2023 is expected to see more retirees than any year in Canadian history. So millions of experienced and hard workers will retire the next few years, and nearly all of this 20% population, the baby boomers, of our workforce is expected to retire this decade. So our worker shortage is likely to continue as a trend to work from home continues and the baby boomers retire. Stagflation, that's been talked about a bit in the news. So let's talk about that for a minute. So now stagflation, will 1980 stagflation in return? Stagflation means high inflation combined with high unemployment and low GDP growth. So, all right, so we had that in the 80s. It was a specifically definition of what it is. Now, note there's a major difference between now and the 1970s and 80s. We had high unemployment of 8 to 12% for most of those decades, but low unemployment now, about 5%, and expected to stay low for years. So here, if we look at unemployment for the last 50 years, note how it was low in the 1960s, how high it was from 1975 to 95, and how low it is now. So now stagflation includes low GDP growth of the economy. Canada actually had decent growth in the 1970s and 80s, averaging about 4%. At the time, we thought growth was slow because it was less than the 1950s and 60s when we had growth of 5%. So I find it quite funny when we talk about, low GDP growth of stagflation in the 70s and 80s. It was 4%. So that's a lot higher than growth of our economy since then. Today, 4% of our growth of our economy is a distant memory. We think of 2% growth as really good. Since then, our growth has continued to slow. From 2000 to 2015, our growth averaged about 3%. The economy grew about 3% every year. From 2015 to 2019, before COVID, it's slowed further to about 2%. And now, after COVID, our projected growth for the rest of the decade is down to 1%. So we're just going slower. So if we look at this chart, you can kind of see it on this chart. So this chart is real GDP, meaning the growth of our economy after inflation. Note the steady decline over all of the last 60 years. 5% in the 1960s, 4% in the 70s to up to 2000, 3% from 2000 to 2015, 2% from 2015 to 2019, and now projected to be down to 1%. So our growth is expected to slow even more to less than 1% for the rest of this decade. The OECD predicts Canada will have the slowest growing advanced economy of 38 OECD countries for the rest of this decade and the next 3 decades after that. So this is not inflation, it's political. Growing our economy and our standard of living and being competitive internationally are simply not priority in Canada today. If you listen to how people talk and what's on the news, nobody's talking about our economy is, almost entirely stopped growing. It's not talked about anywhere. Economic growth is almost gone in Canada now. Will likely fall from the ninth largest economy to the 11th soon, as the economies of little tiny South Korea and Brazil pass us. So, we've been always in the top 10 economies in the world. That's probably going to end shortly. So this is one of the main reasons we invest almost entirely outside of Canada. There's lots of growth for global investors, but not that much for Canadian investors. So in short, we do not expect, stagflation, because inflation is likely temporary, and unemployment should stay low. So if inflation does last for years, we would get a type of stagflation, but different. So growth will be low, but unemployment will likely stay low. In the 1970s and 80s, we had stagflation with high inflation and high unemployment and low growth by 1970 standards, but high by today's standards. So today we have high inflation, hopefully temporary, but low unemployment and low growth. So it's a different kind of stagflation. So we could still have, moderately high inflation and low growth. Government deficits, another big piece. So Milton Friedman famously said, inflation is always and everywhere a monetary phenomenon, in the sense that it is and can be produced only by a major rapid increase in the quantity of money, larger than output. In other words, too much money chasing too few goods and services, and we're testing this now. Now, the COVID stimulus was truly unprecedented money printing. It was by far the largest in history. Essentially, we borrowed 400 billion, actually about 500 billion, from investors by issuing government bonds. This money ended up in the hands of Canadians, either directly or indirectly. So most Canadians actually had higher income during COVID, other than small businesses who basically took the major part of the brunt of COVID. And Canadians were also spending quite a bit less. So we had a record high disposable income and record new investment account openings. It's amazing how many new investment accounts were opened up during COVID. People were home, they had lots of money around, so they weren't traveling and no entertainment. So lots of money to spend, and incomes were generally up because the COVID supports in most cases were, a bit higher actually than income lost. So at least in very many cases. So Canadians now have record high cash holdings and pent up spending demand. This has been one of the main causes of recent inflation. After being locked up for 2 years, we're out driving, going to restaurants and entertainment, lots of shopping. Supply issues such as supply chain and transportation issues, oil refineries slow to open, workers slow to return, could not keep up with the surging demand. So all of that's been going on, but we're working through it slowly. It's not gone yet. All right, so bottom line now, the Bank of Canada should make sure inflation comes down. At least we certainly hope that they do. The main reason I believe inflation will come down is because this is the main job of the Bank of Canada and the Federal Reserve in the US. So our central bank is mandated to keep inflation between 1% and 3%, with a target of about 2%. So they were very successful at this from 1992 up till 2019. So inflation stayed close to 2% for 30 years. So if the Bank of Canada does its job, inflation should come down to 2 to 3%, hopefully within 1 to 2 years. The only question is, how high do interest rates have to be to bring down inflation, and how long do they have to stay high? So they will keep interest rates high until inflation comes down to their target range. So I fully applaud this. Inflation is the number one risk to our financial futures and our clients' retirements. The question is not really whether inflation will come down, but how high interest rates will have to be to keep inflation low. This means interest rates will likely go back to normal or a bit higher. It's possible that we'll have an extended period of somewhat higher interest rates because of, to try to keep inflation low again. Now, there are some risks to this. So, the Bank of Canada mandate was changed in 2021. So, they now have two jobs: keep inflation about 2% and create, quote, maximum sustainable employment, unquote. So, for the last 30 years, they've had one job, 2% inflation, and they succeeded at keeping it about 2%, which was great. Now they have two jobs. So it took 20% interest rates and two recessions to bring down inflation in the 1980s. Will the Bank of Canada focus on avoiding a recession because it would increase unemployment? If so, will that make them less effective at reducing inflation? Now, in my view, adding unemployment as a second job for the Bank of Canada was a political decision, but it's a financial risk. Unemployment is a lagging indicator, which means it usually takes a year or more for unemployment to respond to what's happening in the economy. So the Bank of Canada, the Fed in the US are already almost always very slow to respond. The investment industry widely wanted interest rates to start rising in October 2021, way back there, and believes the Bank of Canada was about 7 months too slow in starting. And that's part of why they had to jack them up so fast, the interest rates. So this mandate change may make them even slower and less effective. Scenarios where they lose control of inflation to avoid creating a recession are unlikely, but more likely with this mandate change. So now we're expecting a bit of recession this year, and I really hope the Bank of Canada doesn't worry about that at all and just stays focused on inflation. So the two mandates should not be a problem this time, since unemployment is very low and likely to stay low even if we have a recession. The second risk is the battle between the federal government versus the Bank of Canada. So we talked about federal government versus municipalities on housing. Now, federal government versus the Bank of Canada. So governments have two main tools to control the economy. So fiscal stimulus is what they call it, is government spending money and running deficits to create growth. And the other one is quote unquote monetary policy. The Bank of Canada, which is the Bank of Canada raising interest rates to slow the economy. Today, these two are pushing against each other. So the government and the Bank of Canada are a bit in a battle. So the Bank of Canada tends to raise interest rates until inflation is under control. The government plans to continue to have large deficits and print money, which stimulates inflation. So the government's stimulating inflation, the Bank of Canada is trying to keep it down. And that's why we may have to keep, inflation, interest rates may have to stay high for a fair while, as long as we have these higher government deficits. Now, this year's federal budget projected a deficit of 40 billion, but this federal government has not come close to their projections in most years. There are some projections of reducing it to 30 to 50 billion in a couple years. Many permanent new programs have been added, so deficits may well stay at the 50 to 80 billion per year. Until the last few years, $20 billion deficit was thought to be a huge, and governments targeted living within their means by balancing their budget, so no deficit. So that has been the goal. When we had our 20 years of very low inflation, the government during that whole time always had the objective of balancing the budget and not having deficits, and that's gone now. So the risk here is that government debt increases are permanent. If we look at government debt, our federal government debt is 500 billion higher than pre-COVID, and this debt will all be owed 100 years from now. So debt, again, just like inflation, is permanent. So this year's 50 to 80 billion additional debt will also be permanent. All of us and our kids will pay interest every year of our lives on this debt, plus the new debt from every deficit in the future. So government debt, the huge increases are permanent, and they're permanent, increases in the government. They have to pay the interest forever. So we learned our lesson after previous inflation and balanced budgets for 20 years. However, we seem to have forgotten that lesson since 2015. Will Canada become financially responsible again, or continue to pile up more and more debt? So in the end, the Bank of Canada should win over this battle with the government. The worst case is that money printing may just mean interest rates will have to stay higher to keep inflation down to the 3% range. All right, last thing I want to talk about is how to solve inflation. There are 7 ways to solve inflation. So how likely do you think these are to happen? So let's look at them. So one is supply chain issues. They've been working themselves out. They should all work themselves out shortly, so in next year or so. But anyway, so that one should probably solve. Number two, the Ukraine war ends. So now this is likely going to be a few years, but it will end eventually. So it has not hurt the Russian economy, despite what you hear on the news. Russia's economy grew more than Canada's in 2022. So Putin is popular in Russia since he controls the media and what Russian people hear about the war. So there's no immediate rush to end it, but it'll end at some point. So those two will end. Supply of oil increases could also stall inflation. We need to increase enough to keep the growing global demand so that we don't get, higher oil prices and higher gasoline prices. So 3 billion people still live in extreme poverty, and developing countries are slowly moving to middle class, which should keep global demand rising. So this should keep the price of oil and gasoline, at current prices, as long as, we keep getting increases in supply to match it. Now, that one is maybe more of a risk than the first two. Fourth one, keep immigration high to replace retiring baby boomers. That's a good thing to do. It looks like it's going to happen. Number five, build enough homes for the immigrants, or reduce immigration to the net new homes we are building so we can provide homes for them. So if we keep having more people coming in than homes, the prices will probably keep rising. If municipalities won't allow more building, then it needs to be a higher concentration in the cities. Supply and demand for homes determines home prices, which is a large part of our cost of living. So this one probably is going to be a continuing problem. Governments going back to fiscal responsibility and balancing budget. We all have to live within our means. Governments should be example. I tell people all the time, governments are like the worst example of how to balance your budget. So this one is highly unlikely to happen. Like we expect that deficits will probably continue to stay high for a long time. Bank of Canada stays focused on inflation and keeps interest rates high until inflation comes down to the 1 to 3% target. It looks like this one will happen. High interest rates are less of a problem than letting inflation last longer and becoming an expectation. So this may cause a recession, but probably not high unemployment. So these rates staying high, and that will probably, this is the sixth thing, and it probably will happen as well. So if we look at all the reasons, most likely we are going to solve inflation. So because most of those reasons are probably going to happen. All right, so quick summary. Why is inflation scarier than the market crash? Stock markets have recovered from 100% of crashes, but inflation is a permanent increase in our cost of living. It piles on top of the inflation from all previous years. So should we be worried? I agree with most economists that inflation should come down to the Bank of Canada's 2 to 3% target. However, I'm very aware that high inflation lasting quite a few years is probably the single biggest risk to our financial futures. Years of high inflation are the number one risk to Canadians having a sustainable retirement. The Bank of Canada needs to keep interest rates high until inflation comes all the way back down. We cannot let inflation become an expectation. How long is it going to last? Many factors affect this, so any forecast is far from certain. I agree with most economists that inflation should come down to the 2 to 3% within 1 to 2 years. Worst case, inflation stays high, becomes an expectation, interest rates stay high. They won't be anywhere close to 20%, but staying above 5% is possible. Best case, interest rates stay at this level, and this best case is probably the most likely case as well. Interest rates stay at this level this year and bring down inflation by next year, so interest rates can start to decline. That's what we think is most likely to happen. All right, so thanks a lot for listening. Again, what we learned today is we learned why is inflation scarier than a market crash, even the Great Depression size crash. Why do inflation and market crashes affect your retirement plan? Why are expectations for inflation so critical? Should we be worried? How long will it last? What's happening with each of our causes of inflation? What does today's inflation, how does it compare to past periods of high inflation? And how do we fix inflation? All right, so thanks for listening. So my name again is Ed Rempel. My blog is Unconventional Wisdom. It's the #1 blog in Canada for a financial planner. Also have a YouTube channel, and now just recently a podcast. So please like and subscribe to the podcast and the YouTube channel. And all that means is that you will get our videos and my videos and podcasts. You'll get a notice directly to your email every week as they come out. I'm planning to do 2 podcasts a week for the next 6 months. Tuesday and Thursday, and a video and a post every Thursday. So if you go to my blog, which is edrempel.com, hit contact, you can ask for a free 30-minute consultation. All right. And that is just if you're potentially interested in working with us, that's just a way to find out. There's no pressure at all. That the consultation is just to find out what are you looking for and what do we do? Are we fit to work together? All right. So thanks a lot for listening. Please subscribe to the YouTube and to the podcast and to this blog, and we'll talk to you next week.